Okay, here's the verbal discussion about Chapter 1, Adjusting the Accounts. So here's our learning objectives for this particular chapter, and we will cover all of those in this PowerPoint. So the first learning objective is identify activities and users that are associated with accounting. So basically in accounting, we are identifying what transactions need to be recorded. We then record those transactions and we communicate those events with interested users. And how we communicate them is through financial statements, which we will get to in a future chapter. So who are those users? This slide shows you the internal users, the people within that company. So the stockholders who are part owners of that company, the marketing department, our human resources department, the production management line, all of those people use accounting data to make decisions about the business and to make themselves more efficient and the business stronger. External users are people outside of the company, so people who want to invest, potential investors, as well as creditors, people who we are going to borrow money from, so like banks, or if we were to issue bonds, individuals can invest in bonds and those people would be creditors. The next learning objective is our basic building blocks of accounting, and then we'll also talk about ethics and principles and some assumptions that go along with that. So ethics are very important to accounting. So they list here some financial scandals that happened in the early 2000s with the fall of Enron and WorldCom, and Arthur Andersen was their auditors, and they also went out of business. So during that time, we realized that there was businesses that were doing things obviously unethical to inflate their earnings, to get more people to invest in them, which would increase their stock prices. And many of it was inside jobs where the people who worked there were getting financial gain from doing those things. So during that time, with all the bankruptcies and again the fall of Arthur Andersen, which was one of the big worldwide auditors, they came up with this Sarbanes-Oxley Act. So the Sarbanes-Oxley Act basically says that publicly traded companies need to have solid internal control structures that can be tested by auditors, and then that investors can have confidence that those procedures are actually going on, and then in turn that would result in financial reports that we could all trust. So here's some of the steps. You have to obviously recognize if there is an ethical situation and what type of ethical issues are involved. Identify the people who could be harmed. So if you see that something unethical is happening, then what are the ramifications of that? Who all could be hurt? And then weigh those alternatives to say, okay, well, what could I do? Like, what is going to be the right answer to handle this situation? So companies need to, make those decisions as they're facing any of those ethical dilemmas. Then we move on to generally accepted accounting principles, which is abbreviated as GAAP, G-A-A-P. So if you hear that word GAAP, you know what that stands for. There are a lot of acronyms in accounting, so you got to get kind of accustomed to those, but GAAP is your first one that we'll talk about. So again, that is what the generally accepted accounting principles do, is say that every especially in the United States, every publicly traded company that's operating in the United States follows these same principles. So then that way, as investors or potential creditors, we can feel confident that the balance sheet and the income statement that we're looking at are accurately presented, that they are true and acceptable, and they're the same across the board. So whether I'm looking at Disney or I'm looking at Pepsi, they're both using the same generally accepted accounting principles, so I can compare those financial statements and make an educated decision. So there's different standard setting bodies. So there's the FASB, which is the Financial Accounting Standards Board. There's the SEC, which is the Securities and Exchange Commission. And then there's the IASB, which is the International Accounting Standards Board. So FASB is very common to talk about, and the SEC is also very common to talk about, because any publicly traded company needs to register with the SEC in order to sell stock. And then there's IFRS, which is it's always talked about that eventually we'll want to be on an international accounting standards, so that all companies around the world are using the same. We're not quite there yet, but the European Union, all the countries within the European Union follow the IFRS. Then we get into measurement principles, and these are just general rules of accounting. So the general rule of accounting that when we have a transaction, we always record it at that historical cost. So whatever we truly pay, or the value that is given up to, to get that service or that asset, is what we're going to use to value it at. The fair value would say that there's some assets and liabilities that will be reported at fair value. So fair value could be different than the cost that we pay. Again, maybe we get a great deal and our cost is lower, but the fair value is higher. So again, we're going to always be more conservative and follow that historical cost principle, unless it would specifically tell us in some scenario to value it at the fair value. The monetary unit assumption assumes that all of our financial transactions are going to be expressed in monetary terms. And in our case, in the United States, it's all in the US dollar. If you're in that European Union, you're going to probably report it in euros. But for us, it's US dollars, and that's what we should be used to seeing our financial statements in. And then it's an economic entity assumption. So normally what we focus on is corporations. So a large publicly traded company is a corporation, but it could also be a sole proprietorship or a partnership. But those are obviously going to be smaller forms of business. So then here gives you the little rundown of those. So a sole proprietorship is owned by one person. They are the manager and the operator. They receive all the profits, they suffer all the loss, and they're personally liable for anything that happens. So if there's any type of liability for debt or any type of accident that happens or damages, all of those things they're going to have to be responsible for, and they can be responsible out of their personal assets. So again, that's a little bit of a risky one, and normally it's obviously smaller businesses. Partnership is often the same as a sole proprietorship from the liability standpoint, except now there's two or more people. So two or more people are going to come together to form this business, but they will have unlimited personal liability with themselves as well as their other partners. And then normally there's a clear partnership agreement that spells how the profits will be paid out, and how liabilities will be shared and all that type of thing. And it's very important to have that partnership agreement. Corporations are the ones that we primarily focus on in our examples, and those are a separate legal entity that is organized under a specific state that they are incorporated in, and it's owned by a whole group of people. So anyone can have shares in these publicly traded companies. So you could have, millions or thousands of shareholders that are part owners of this corporation, and they all are limitedly liable. So limited liability means that they will only lose up to their investment. So say I invest $5,000 in Disney stock. I am now part owner, a very, very small percentage of the ownership. But say something horrible happens at Disney and there's a big lawsuit and they close down. Well, no one's going to sue me personally, but I could lose my $5,000 that I have invested in them. So that is what that limited liability refers to. Then our third objective is to understand the accounting equation and understand all of its components. So this is a formula you definitely want to know. It's our basic accounting equation. It's assets equal liabilities plus stockholders' equity. So you want to understand that, and then eventually we'll get into like debits and credits that are associated with those. But generally an asset is something that the company owns and has a value to them. A liability is something that the company owes, so they owe money to somebody else. And then stockholders' equity is the owner's equity. So it's kind of what's left over. Your assets minus your liabilities will leave you with that stockholders' equity. But it is also what the the investors have paid into the company. It represents their investment in the stock of that company. So again, so this is going to clarify it in detail. So our assets, again, like I said, it's a resource that the business owns. It could be like a prepaid revenue or a prepaid insurance where it'll provide future services. And examples are cash, inventory, equipment, things like that. The liabilities are, again, what the company owes, so claims against the assets, debts or loans or obligations to people they've purchased product from, accounts payables, notes payables, wages payables, real estate taxes payable, anything payable or an accrued expense would indicate that that's something that we owe somebody. The stockholders' equity, again, is that residual equity because, like I said, it's basically your assets minus your liabilities are going to equal that stockholders' equity, but it's everything that's in common stock and then the retained earnings that the company has kept. So retained earnings are net income that the company has made in the past that they did not pay out to the owners. So they retained those earnings. So then here kind of shows you again some flows as to what impacts some of these things. So if we have in stockholders equity, things that make stockholders equity go up are investments by new stockholders, revenues that come into the company, and things that make it go down are if we pay dividends out to those stockholders or we have expenses that offset those incoming revenues. Things that increase revenues, those are going to be like sales and fees and services, interest income, dividend income, if we have rental income. So again, anything that's income or revenue related, something that the company is making money on. Dividends are a distribution of those earnings. So like I had said earlier when I talked about retained earnings, the company can choose to keep their net income themselves, and then that's what we called retained earnings, or they could choose to give it back out to their shareholders, and how they do that is in the form of dividends. So then every shareholder gets a certain dollar amount, and they may do a combination. They may pay out some dividends plus keep some retained earnings. Expenses are again things that the company incurs to earn those revenues. So it could be labor costs, which would go into our salaries expense. It could be rent for the building that they're operating, utilities for those buildings, insurance expenses, property tax expenses. Anything that it's costing money for them to do business would be considered an expense, and it's kind of used up in order to generate the revenue. Then our fourth learning objective is to analyze what business transactions happen and then how those then impact our accounting equations. The assets equal the liabilities plus the equity. So here again is this little kind of, kind of how the different transactions go in. We journalize them, we post them, we create a trial balance. Excuse me. We do adjusting entries. We'll have an adjusted trial balance, which we prepare financial statements. We'll do closing entries and then a post-closing trial balance. So that's like the big long picture of accounting. We're not quite into all of that yet, but just looking forward to that. So then here is our accounting equation kind of broken down into some details. So like we said, our stockholders' equity is our common stock and our retained earnings. But what funnels into retained earnings is our net income. And our net income is revenues less expenses. And then, like I said, when it comes to retained earnings, the company can either choose to keep them or pay them out in dividends. So then that's also why we subtract the dividends. So here's some transactions so you can kind of think some of this through. So if we have this company who start a development company that they've incorporated, and this company invests $15,000 in cash into the business. And again, they're the owners, but so they're going to put that investment in and it's going to go in as cash, and they're going to receive $15,000 of common stock to represent their ownership in this company. So then here, if we look at how does that hit the ledger, We've got $15,000 coming into our cash account, which is an asset. It's something the company owns. And then we have $15,000 coming into common stock because it's creating the stockholders' equity. And then our equation balances because we have an increase to our assets and then an increase to stockholders' liability. Okay, then we have a second transaction. The company now purchases a computer equipment. So again, they're going to pay with cash, so that's going to reduce their cash, but then they're going to increase this asset called equipment. So nothing changes on this side of the equation. Our assets go up and our assets go down. Well, it's cash for equipment. Okay, then if we purchase supplies on credit, if it's on credit, it means we didn't pay cash yet, we set up a liability. So then here we'll have supplies being increased because we purchased them, but then now we have this liability called accounts payable. Accounts payable is by far the most common liability that companies have. Everything that they receive invoices for goes into accounts payable. So then that will increase our accounts payable. And again, the equation balances. Assets go up, liabilities go up. Okay, then we receive $1,200 for cash from customers for services that it has performed. So if we've performed those services, that's revenue to us. So then if we come over here into our retained earnings section, our revenues go up and then we were paid cash. So our cash goes up. Okay, then now we have a bill. So we advertise to try to create these revenues. So we pay a bill. Oh no, so we postpone payment until a later date. So we're going to have the expense, but we're going to put it on our accounts payable or our credit. So then we come in and we say, okay, we have an expense. So that's going to be a reduction to those revenues. And then now we've increased our accounts payable because we didn't pay it yet. We still owe them. So that's a liability. And again, everything balances, but it's on this side of the equation. Our liabilities go up and our equity goes down. Then we have services performed for cash and credit. So we perform $3,500 worth of services. $1,500 of that is paid to us. And then the remainder, we send a bill to the customer and give them so many days to pay. So then in that case, we record all the revenue because we've earned it, we've completed it, we've done it. So that's an increase to the revenue. We've received cash for some, so that makes our cash go up. But then now we create this accounts receivable. So accounts receivable is an asset because it's money that will come into us in the future. Possibly we give them 30 days to pay. So maybe next month we will collect on that accounts receivable and then it will turn into cash and reduce that when we eventually collect. Okay, then now we pay the following expenses. So we pay office rent, salaries and wages, and utilities. And these are monthly expenses that are probably paid every month. And you can see then we come down here, they all go into our expense. Again, they're necessary costs in order to help us generate this revenue. So we're going to reduce the earnings accordingly. And then we're also reducing our cash because we paid for it. And again, our equation balances. Then we pay the accounts payable. So remember, we had a couple transactions that we did not pay in cash. We set up a liability. Well, eventually you got to pay them. So the due date comes and now we pay. So then we pay with cash. So that reduces our cash. And then it reduces the liability. Because if we look up here, that's where we set the liability up. Now we're taking it away. Okay, then now we receive some of the cash on the customers that we set up in accounts receivable. So the cash comes in. Here we set up their receivable at $2,000. So now we need to reduce that. They no longer owe us. They've paid us in cash. So we reduce the accounts receivable and we increase our cash. Okay, then we pay out some dividends. So now it's maybe the end of the period and we decide we're going to pay out some dividends to the two stockholders. And if we pay it out, it's in cash. So we're going to reduce our cash by that amount. And then the dividends, again, are a reduction of the retained earnings. What the company has in net income is being paid out to the shareholders. So again, our equation balances. So then again, summary of those transactions, we have to look at and analyze each transaction to find out how it impacts and how we record it and how again it impacts that accounting equation. It's an equation, so by definition it always must be equal. So what we do to one side, we've got to do to the other, or again it could be both on the same side. So you have to make sure you kind of understand the flow of those transactions. Then we're gonna, once we have recorded, all those transactions, there's 4 financial statements that companies prepare. So they prepare an income statement, a retained earnings statement, a balance sheet, and a statement of cash flows. So this gives you an example of our income statement. So think about that. Income is what am I making? So what am I making? It's my revenues, all of my income or my revenues, less all of the expenses that I incurred to make that revenue. So revenues less expenses provides net income, and then net income rolls into retained earnings. And then again, like I said, this is how much the company has. They have 2 choices. They can pay it in dividends or they can retain it. So in this case, they did both. They paid some of it out in dividends to the owners, and then they retained the rest. And we'll see that the amount that they retained stays in our balance sheet. So then we come down here and we look at our balance sheet, and the amount that the company retained rolls down into the company's balance sheet because it is creating equity. They are keeping that money and it's building their equity. So then their balance sheet, we have all of their assets that we recorded, less their liabilities and their stockholders' equity. So in this case, we only have the 1 accounts payable that didn't get paid, and then we have the amount that the couple initially invested as our common stock, and then the retained earnings that we just determined from that statement above. Then we go into our statement of cash flow. So this is definitely a more advanced accounting topic that you necessarily don't need to worry about being able to prepare, but you just want to understand the statement of cash flows. What the statement of cash flows is doing is just trying to show a user how the cash is being spent. So they have their cash flow from operating activities, again, their revenues less their expenses. They have their cash flow of investing. What are they putting money back into the company in? So they purchase some equipment. And then from financing, so if they got a loan, that would be in the financing, but in this case all they did was sell common stock and pay those dividends. So it's just kind of break the use of cash down into those 3 categories: operating, investing, and financing. The income statement, though, is definitely an important one. You want to understand, and you want to understand how to prepare it. So you're going to always list your revenues first, and then you're going to deduct all your expenses. If your revenues are more than your expenses, you have net income. If your revenues are less than your expenses, then you're going to have a net loss, or it's going to be a negative number. And sometimes they'll show it in parentheses, which indicates it's a negative number. The statement of retained earnings, again, you want to just remember net income always rolls into it. And then the company has 2 choices. They can retain it or pay it out. So they'll have net income less the dividends that they pay out, and that'll leave us with our retained earnings, which then will roll down into our balance sheet. And our balance sheet is basically the accounting equation, but in a statement. So it's your assets on one side, then your liabilities plus your owner's equity on the other. And your total assets have to equal your total liabilities and your owner's equity. And again, the balance sheet is, like it says here, a snapshot in time. It's a as of date, whereas our income statement is for a period of time, like for the whole year, for the quarter, for a month. And then the statement of cash flows, again, I'm not going to have you prepare those in principles of accounting, at least. When you get into financial accounting, we will probably get into preparing a very basic statement of cash flows. But what you're looking at is kind of you're identifying where the cash is coming in from and what it's being used out for. And from a standpoint of, is it operating, is it investing, or is it financing? And operating is basically used to produce revenues. Investing is when we put money back into ourselves, so we buy assets. And then financing is where are we getting the money? Did we get loans? Did more people invest in our company in the form of stock? Where did the money come in from? And then plus, did we pay out dividends? So that is the first chapter. And there is a lot to absorb in there, so please take the time to read it and read through the notes.